ESG factors can have a significant influence on both industry-level dynamics and company-level performance because they affect operating conditions, competitive positioning, regulatory exposure, stakeholder relationships, and long-term value creation. Environmental, social, and governance issues increasingly shape market expectations, consumer preferences, capital allocation decisions, and business strategies. As sustainability concerns become more prominent, companies and industries that effectively manage ESG risks and opportunities may achieve stronger financial performance and greater resilience. Conversely, organizations that fail to address material ESG issues may face higher costs, operational disruptions, reputational damage, and declining competitiveness. Understanding these relationships is therefore essential for comprehensive investment analysis and sustainable decision-making. At the industry level, ESG factors can influence the overall attractiveness and future prospects of sectors. Environmental regulations, technological innovation, climate policies, resource constraints, and changing consumer preferences may alter industry structures and competitive landscapes. For example, industries with high greenhouse gas emissions may face increasing regulatory costs, carbon pricing mechanisms, and transition risks. Conversely, sectors associated with renewable energy, energy efficiency, sustainable agriculture, or environmental technologies may benefit from supportive policies and growing demand. Social and governance trends can similarly reshape industries by affecting labor practices, product standards, consumer expectations, and stakeholder scrutiny. As a result, ESG developments often create both risks and opportunities across entire sectors. Environmental factors can materially affect company performance through their impact on costs, revenues, asset values, and operational resilience. Companies with significant exposure to climate change, resource scarcity, water stress, pollution, or biodiversity loss may encounter increased operating expenses, regulatory obligations, and physical risks. Organizations that proactively manage environmental issues often improve resource efficiency, reduce waste, strengthen resilience, and enhance their reputations. Environmental leadership can also create competitive advantages through innovation, product differentiation, and access to new markets. Consequently, investors evaluate environmental performance to assess how effectively companies are positioned to manage risks and capitalize on emerging sustainability-related opportunities. Social factors influence company performance through relationships with employees, customers, suppliers, communities, and other stakeholders. Effective human capital management, workforce development, diversity and inclusion initiatives, health and safety programs, and responsible supply chain practices can contribute to productivity, innovation, and stakeholder trust. Companies with strong social performance often experience higher employee engagement, lower turnover, stronger customer loyalty, and enhanced reputational capital. Conversely, poor labor practices, product safety failures, data privacy breaches, or stakeholder conflicts can result in litigation, regulatory penalties, operational disruptions, and reputational damage. Social factors therefore represent important determinants of both operational performance and long-term business sustainability. Governance factors play a particularly important role because they influence how organizations make decisions, allocate capital, manage risks, and maintain accountability. Strong governance structures support effective board oversight, transparent reporting, ethical conduct, and strategic discipline. Companies with robust governance practices are often better positioned to navigate uncertainty, respond to stakeholder expectations, and execute long-term strategies successfully. Weak governance can lead to conflicts of interest, poor risk management, financial misstatements, and strategic failures. Investors frequently view governance quality as a leading indicator of management effectiveness and organizational resilience. Consequently, governance analysis provides valuable insights into a company's ability to create sustainable shareholder value over time. The interaction between ESG factors and financial performance is often complex and dynamic. ESG issues rarely operate in isolation. Instead, environmental, social, and governance factors frequently reinforce one another and collectively influence competitive positioning and risk exposure. Companies that integrate ESG considerations into strategy, operations, and decision-making processes may improve resilience, strengthen stakeholder relationships, and enhance long-term profitability. Industries undergoing sustainability-related transitions may experience significant shifts in growth prospects, capital flows, and competitive dynamics. By analyzing ESG factors alongside traditional financial metrics, investors can develop a more comprehensive understanding of industry trends, company performance, future risks, and long-term value creation potential.